How much should you invest each month in order to retire comfortably? In this video, I'll show you a range of different scenarios in the UK based on your age, monthly investment amount, and the level of comfort you are seeking in your retirement. This is not investment advice and is for entertainment purposes only. According to the Pensions and Lifetime Savings Association, there are 3 levels of retirement living standards: minimum, moderate, and comfortable. I'll first look at the minimum retirement standard. The income you will need for the minimum standard is $14,400 a year for a single person, according to the PLSA, and this will cover your essential needs with some left over for fun. This includes £100 to help maintain your home, £50 a week on groceries, £25 a month on eating out, and £15 per fortnight on takeaways. Transport costs do not cater for a car, I'm afraid, but there is enough for £10 a week on taxis and £100 per year on rail fares. There is enough for a week-long UK holiday, basic TV and broadband, plus a streaming service. Up to £630 on clothing and footwear each year, and £20 for each birthday and Christmas present, plus £50 for charity donations. So in order to reach this minimum standard, we are going to have to build a pot of money large enough to generate £14,400 a year in retirement. One important source could be the UK state pension, but there is no guarantee that this will be available to all of us in the future. So for this exercise, I'm choosing to ignore it and instead look at how investing in the stock market alone could fund your retirement. I'm going to introduce something called the 4% rule, which you may well have heard of. This is a retirement strategy that suggests withdrawing 4% of your initial retirement portfolio each year adjusted for inflation. The idea is that by following the 4% rule, investors should be able to avoid running out of money over a 30-year period. There are of course no guarantees that you won't run out of money, just that it has a very low risk of failing based on historical data. Now, to be able to cover the yearly cost of £14,400, our portfolio size would need to be £360,000, because if we withdraw 4% of this in retirement, we will have £14,400 to utilise. So the next question is, how do we build a portfolio amounting to this size in the first place? Well, this is simply a matter of regular investments and the magic of compounding. The S&P 500 has historically returned just over 10% per year. So you could buy a low-cost S&P 500 index tracking ETF. If you started investing in such an ETF at age 20, you would need to put in just £32 a month to reach £360,000 age 66. That's £32 every single month until you reach 66 years of age. However, if you delayed your investing journey until you were 30, then you would need to put in £86 every single month until you hit 66 years of age. At 40, you would need to invest £244 a month, and if you started at 50, the figure would be £766. Waiting until 60 would be a tough ask, as you would need to put in a staggering £3,670 a month. By investing later, you miss out on the effect of long-term compounding. Now, you have probably started your investing journey already, but are you on track to at least cover the minimum standard at this moment in time? This table will show if you are on target. For example, if you are 30 years old and fully invested in, say, the S&P 500, and your portfolio is larger than £6,555, then you are on track. If you are 50 and your portfolio is over £72,000, then you are also on track. I'll repeat that these figures are based on the S&P 500 with a 10% annual return. Nobody knows for sure what the future returns will be. Historical returns are not a guarantee of future returns, so take this with a pinch of salt. It's a bit like driving a car looking in the rearview mirror only. The view behind you might not be the same as what's coming up ahead. We are just using historical returns here. For couples, you would need £22,400 a year combined, and the pot size on an assumed retirement at age 66 would need to be £560,000 between you to generate enough income following the 4% rule. Here is the data for couples if they start investing at various ages and how much money combined they would need to invest consistently each month. The younger you start, the less burden there is each month. Now, couples are not necessarily going to be the same age as each other, but it will at least give you a general idea. This table shows what size your total portfolio should be at a given age if you are a couple and investing in the S&P 500. So a couple age 45 with a joint portfolio size of 65k are on target to meet the minimum retirement standard. Now, if meeting that standard was a walk in the park for you, then how about meeting the moderate retirement standard? This requires £31,300 a year for a single person and gives you more financial flexibility and security. This time you could have one foreign holiday a year, eat out a few times a month. You'd have the opportunity to do more of the things you want to do, and there would be enough, would you believe it, to run a 3-year-old motor car and replace it every 7 years. Happy days. To generate £31,300 a year, we will need a portfolio size of £782,500 at our retirement age of 66. So if you start your investing journey at say 30 years of age, you would have to invest £187 a month until you are 66. But leave it to age 60 and you will need to invest almost £8,000 a month to reach the target. Okay, time to see how we are doing now compared to the moderate standard. If you are aged 40, for example, and have a portfolio size of around 51,000 today, then well done, you are on track on historical S&P 500 performance. To reach the moderate standard for couples, you would need £43,100 a year combined, and the pot size on an assumed retirement at age 66 would need to be around £1 million combined for you to generate enough income following the 4% rule. If you start investing age 30, then you will only need to invest £257 a month between you until you retire. Don't leave it too late to start your portfolio, because if you decide to start investing age 60, you are going to have to put away almost 11 grand a month. So as a couple, are you on track to meet or surpass the moderate standard? If you are both around 40 years of age and have a combined sum of around 70k stashed away in the S&P 500, then congratulations, you are well on your way. Okay, now for the big one, the comfortable retirement standard, which is the highest one and has a yearly cost of £43,100 a year for a single person. It gives you more financial freedom and some luxuries. This lifestyle allows you to be more spontaneous with your money. You could have a subscription to a streaming service, regular beauty treatments, a foreign holiday, and several UK mini breaks a year. Yes, and there's that fabulous motor car, which you can now afford to change every 5 years. So as a single person, you are going to need a portfolio size of just over £1 million at age 66. But wait, haven't we seen these same figures already? Well, yes. Basically, according to the PLSA, the cost for the comfortable standard for a single person is identical to the cost for a couple seeking the moderate standard. But here are the figures anyway, only this time you have to achieve them all by yourself. And here is what your current portfolio size should be as a single person to reach this top standard. If you are aged 30, for example, and have grown your portfolio to £19,000, then jump up and down with joy. You are well on your way to the highest retirement standard. To reach the comfortable standard for a couple, you would need £59,000 a year combined, and the pot size on an assumed retirement at age 66 would need to be just under 1.5 million combined for you to generate enough income following the 4% rule. If a couple are starting their investment journey age 30, then they will have to put in a combined sum of £351 every month until retirement. Let's not even look at what's needed per month if you start investing at age 60. I think we'll quickly move on. So, are you as a couple on track to reach a comfortable retirement based on the historical returns of the S&P 500? Well, at 50 years of age, if you have a combined portfolio of $289,000, then you are well on your way. And here is a quick summary of the yearly costs per year you will need to cover according to the PLSA. Hopefully from these slides so far you will have grasped the amazing power of compounding. The next example explains it better. From the moment Emma is born, her parents decide to save £20 a month in a piggy bank. When Emma is old enough and earning her own money, she takes over and continues to add £20 a month. From the moment Sadia is born, her parents also put £20 a month away, but instead of a piggy bank, they invest it into the S&P 500, and Sadia takes over when she is old enough. At age 66, Emma opens her piggy bank to find a grand total of £15,840. A nice sum, but there has been no compounding. Sadia, also age 66, logs into her investment accounts. She has also invested a total of £15,840, but the value of her portfolio is £1.7 million. Now, before you go piling into the S&P 500 with all your hard-earned cash thinking it's going to be all plain sailing, there are a few caveats I need to mention. Firstly, there are fees to consider, but the historical annual return of the S&P 500 is slightly higher than the 10% I've used. Still, fees are something to consider, and so of course is tax. Investing using a stocks and shares ISA will of course help. There are unpredictable exchange rate fluctuations which may affect your return also. And finally, being 100% exposed to equities when you near retirement and during retirement may not be the best choice in your particular situation, and is risky. For example, if there is a stock market crash, you may not have a long enough time horizon for it to recover. In reality, you may want to have a broad range of assets which include things like gold and bonds to reduce risk. Finally, the calculations I've shown have not factored in inflation. We don't know what that is going to be. Currently, the Bank of England's long-term target for the UK is 2%, and just a 2% rate of inflation can seriously erode your money over time. For example, £1,000 in savings over 5 years will be only worth £906 in real terms. Over 10 years, this drops to £820. Over 20 years, the actual purchasing power of your original £1,000 has been whittled down to £670. This is with a 2% rate, and it could well be higher, eroding your wealth further. But investing in the stock market over the long term does give you a great chance to beat inflation. The S&P 500 has returned over 10% per year historically, and inflation adjusted its return 6.8% per year. One way to mitigate inflation is to simply increase your monthly contributions in line with inflation as time goes by. Your wages may naturally go up as the years progress. So if, having considered all of the above, and you still want to start investing in the S&P 500, how do we go about it? One way is to open a stocks and shares ISA and invest in an S&P 500 index tracking ETF like the one here. With VUAG, any dividends are auto-accumulated and it can just grow over time. It really is a hands-free approach. It gives you the complete S&P 500 index all in one share. If you had invested in VUAG 5 years ago, the value of your shares would have risen over 90%. A really cost-effective platform to use is Trading 212, and they will start you off with a free share worth up to £100. You can sign up using a link in the video description. The sooner you start investing, the better. Warren Buffett is one of the richest people in the world. He began his compounding journey aged 11. But did you know that 99% of his net worth was accumulated after the age of 65? One of the most important factors about making money in the market is time. You don't have to be smart, you just have to be patient. Please like this video if you found it useful and consider subscribing for more content. See you next time, and happy investing.